Now, the Central Bank of Nigeria says it has no objection to the merger between Access Bank and Diamond Bank, which is set to be completed by the first half of 2019. Access Bank is offering a price of 3 Naira 13 Kobo per share, composed of 1 Naira in cash and the remainder via an exchange of 2 new Access Bank shares for every 7 Diamond Bank shares held. Muyiwa, the regional head, equity research at Standard Bank Group, joins us to discuss this. Also joining us for this conversation is Egie Akpata, director at Union Capital Markets. Gentlemen, thank you so much for taking the time out to join us today. Quite interesting times for Nigeria's financial sector this year. We had Sky Bank go on the become Polaris Bank. Now we're having this merger between Access Bank and Diamond Bank, and of course, there are mixed views on how good the deal is for both parties, for Diamond Bank, especially Diamond Bank shareholders, and what and the value it's both parties are getting. Muyiwa, let me start with you. Looking at this deal, on the face of it, what does it look like to you?
So if I was a Diamond Bank shareholder, I would be taking this deal at this time. So if I think about the valuation we have on Diamond Bank, we're valuing the stock at currently around 0.15 times. And if you think about profitability levels, it's been weak. I think over the past 7 years, the bank has been dealing with asset quality issues. Cost of risk has averaged over 3% over that time. And so shareholders haven't necessarily seen value. So for me, I would see this as a golden parachute from that point of view. So I'll typically I'll be taking the deal if I had that.
I like that golden parachute. Egie, what are your thoughts? I mean, looking at the deal for you, when you saw the deal, I mean, the shares that Diamond Bank shareholders are going to be getting in exchange for, I mean, being part of Access Bank now, what do you think?
I think it's a good deal for Diamond Bank shareholders. I think it's probably on the rich valuation side coming from Access, but given the fact that it's not all cash, it's probably acceptable to shareholders of Access Bank. It's probably dilutive to shareholders of Access Bank on the short term.
Let's talk about how we even got here in the first place. We know that, as you mentioned, for a while, Diamond Bank has been struggling, but we know that in terms of when it comes to mobile banking, digital, payments and all of that, being a retail bank, Diamond Bank has had that as one of its key strengths. Being a retail bank, they've been able to capture that market. But for some reason, I don't know, operating environment, a number of issues that perhaps we could go into later on. But obviously, it ran into some headwinds, and that has brought it to this point. So for an Access Bank acquiring Diamond Bank, obviously there's a large chain, or there's a large retail brick and mortar on part of Diamond Bank. But then, what would you say for you could have been a key turning point for Diamond Bank, where it could no longer exist on its own and obviously it needed help? That's a good way to put it.
So if I look at them, and I would argue that I didn't think they were at that place yet. Okay. And part of the reasons why I would say so is that, so currently, or as at 9 months, capital adequacy ratio was around 16%. It was already very close to regulatory minimum of 15%. I think 16% for a systemically important bank. And so clearly they were operating close to that line. And the bank at the time, or a few weeks ago, already got approval from the central bank to downgrade its license to a national license. So from that point of view, you'd argue that the bank could, to stay as is, could decide to shrink and stay small just to stay alive. So it wasn't really, I wouldn't put them in the same place as a Sky Bank at this point. Okay. And I would argue that based on what we see and know as well, even though if you look at operating performance, it's been weak. So asset quality remains an issue. NPL ratio as at 9 months was already up to 12%. And so you can argue that there could still be some asset quality issues that the bank might still be grappling with. And this, given that for the last 7 years, they've been cleaning up the books, and it seems there's been too much to clean up. And I suppose for me, that's been my concern with Access as well, in terms of how you deal with that asset quality challenge they'll be inheriting.
Now, again, this new entity, I think by assets now, Access, if the deal does go through, 6 trillion, bigger than a bank like Zenith Bank, which is now put around at somewhere around 5.6 trillion. Now, so the question now is, okay, as this entity moving forward with, of course, the NPLs, the asset quality of Diamond Bank, how is this new entity going to proceed going forward? Obviously, I mean, I'm thinking that it's going to now become a too big to fail bank. It's a very systemically important bank, at least from the view of the regulator. But for you, how do you see this bank proceeding forward with all the assets, the state of the assets of Diamond Bank that it has now acquired?
Well, I think, I mean, it's true in terms of assets, loan book, deposits, probably the largest. But in terms of profitability, it probably might not even be a top 3 profitability bank for a while. Because obviously, there are obviously things under the hood in Diamond Bank that are going to come out after an acquisition. And typically, historically, when those acquisitions happen in this market, you'll see write-offs for a while. So there's a sacrifice for short-term profitability. But again, even Access has not been a top profitable bank in terms of profits. So if you're a shareholder and you're worried about profitability and return on equity, clearly this deal is not good for you on the short term. But strategically on the long term, to be a very big bank, biggest bank in the country, it clearly has some value.
Do you share that sentiment too?
Yeah, so yeah, I do as well. And I think part of the challenge as well is, so if you consider that the value, you might argue the Access is the retail franchise and also the low-cost funding or low-cost deposit mix. But in recent times, particularly as at 9 months, cost of funds was already ticking up as well. So even though not coming from deposits, but they seem to have some other borrowings driving up that cost as well. And so at 9 months snapshot and combined entity doesn't really necessarily also give it a low-cost funding mix. And to Egie's point as well, with acquisitions, they seem to be, it's saddled with all sorts of challenges, from people integration to systems integrations. Those take a long time as well. And I suppose from Access point of view as well, they had that experience with Intercontinental Bank, and it's taken a while to come out of that. And I think at the time as well, part of the opportunity was in the deposit mix, a retail franchise they were acquiring at the time, but didn't really translate into low-cost deposits. And it seems that's the challenge they will have as well.
Okay, do you think, I mean, how different do you think it's going to be this time, acquiring an Intercontinental Bank versus acquiring a Diamond Bank? I mean, this is a good retail bank and very strong on digital payments, you know, the whole digital payment front. Do you think that that is one strength that Access Bank can sufficiently or adequately take advantage of?
Yes, I think, I mean, given the price paid for the transaction, I'm not sure a lot of other people would have been able to pay such a price, because they might have not been able to derive as much value as Access Bank can derive, plugging a Diamond Bank into their network. You know, but there's the issue of overlap. Diamond Bank has only just recently done a massive branch expansion, which was funded by 2014 rights issue. So there's a lot of overlap in branches, newly built assets that have to be disposed of in one shape or the other. But for sure, the Access Bank network, having Diamond Bank plug into that network, can derive a lot more value for the combined entity than Access Bank could have done on their own on the short term.
Now, looking at it, I mean, final question, just a few seconds, your thoughts on this. Do you think that this says anything about the state? What do you think this says about the state of the Nigerian banking sector? And I know I've heard some analysts say, you know, why did we, you know, obviously there may have been some signs. Should we have had more stress tests by the regulator? What are your thoughts?
I think there's been concerns about fragility in the sector, and particularly when you consider that we're coming from a recession, banks have struggled with asset quality issues. I think as at 9 months, NPL ratios for the sector stood at around 14%. Capital adequacy ratio for the sector was at 10%, coming from over 16% over a year ago. And so the sector still seems to be strained, and I suppose this combination or consolidation hopefully should help or put some life into the sector at some level. Yeah.
We have about 10 seconds left.
I think it does show that the very low price-to-book ratios in this sector might be acceptable to some shareholders. Most people would have assumed that no bank will accept 0.3 times book, but maybe it does say something about the book, or maybe it does say something about the state of a number of the banks. There are a number of banks that are very low price like this, and the question is, if a transaction was to happen, will they insist on a much higher valuation than Diamond got, or will they accept things at this level? It seems there's a market for transactions at this level.
Okay. All right, gentlemen, we're going to have to leave there. Thank you so much for sharing your perspective on this matter for us. I've been speaking to Egie Akpata, Director at Union Capital Markets, and Muyiwa, Regional Head Equity Research at Standard Bank Group.